Well, good afternoon. Happy Friday, April 11th. Mark Milam here, your mortgage professional. Not my favorite of weeks for mortgage interest rates. In fact, since Monday, we've seen most note rates deteriorate or increase along the lines of 3/8 to a half of a percentage point. That is an extraordinarily high amount of movement in 5 business days. So why is this happening? Well, first of all, let's take a look at it. This is mortgage-backed securities. Today, you can see that we've been selling off. It's actually been a lot worse than it is right now. That thin red line is how bad it got. But over the past 6 business days, we've seen mortgage-backed securities selling off so much so that we're getting back to levels that we haven't seen since January. That's not the direction we need to be going. We want housing affordability to improve, not deteriorate. But what's really fascinating about this time in history, because this is really all centered around our administration's tariffs on foreign nations, is that when the tariffs were first being talked about and potentially drawn up, mortgage bonds were actually improving. You see, traditionally or historically, mortgages or bonds have been a safe haven when there is consternation in the stock market. So if you see the stock market starting to fall, usually people are pulling their money out of the stock market and putting it into the bond market as a safe haven, as a guaranteed rate of return. But that shifted this week. And one of the reasons that shifted is because of all of the brinksmanship around these countries that were trying to impose tariffs upon, or at least increase tariffs upon, that hold a lot of our debt. See, our debt in this country is issued out by treasuries, notes, long-term bonds, and foreign countries buy up this debt and hold it because it is a performing debt, right? The full faith and credit of the United States government stands behind this debt. And historically, over time, a lot of these countries have bought up a lot of this debt. In fact, about 10% of all United States debt is owned by China. And we know what's been happening with the tariff war and the retaliatory tariffs between the United States and China this past week. It has been escalating. Even late today, there's been some news that perhaps we're close to reaching some kind of deal, or at least a willingness to approach a deal with China. That's buoyed the stock market, but it has done nothing for bonds. And the reason behind that is because if China decides, hey, we're not interested in any sort of agreement with you. In fact, we've decided we're going to start dumping your debt. Well, that could have a devastating effect for the United States. That could cause interest rates to go even higher. For that reason, a lot of that money that might get pulled out of stocks and placed into bonds is not going into bonds. In fact, it's going other places like gold, for instance, as a viable investment or an alternative to the stock market and the bond market. So we find ourselves in this very interesting time in history where the stock market isn't necessarily performing super well. Bonds are not performing very well either, and you see sort of a flight to things like gold and commodities that can be a little more proof of these tariff negotiations and inflation. So if we can get past the tariff noise, and hopefully we will soon, hopefully we will see some agreements reached so we can get the market more stabilized. Let's go and talk about inflation for a second. I'm going to flip the screen around here and we'll take our eye back to this metric that we were paying attention to a lot of last year and even early this year. And particularly we'll talk about CPI, or the Consumer Price Index, because it came in really weak. April the 10th, actually it was Thursday, April the 10th. We saw the overall number come in at 2.39%, negative month-over-month reading for CPI. Now, when the Fed starts talking about its target rate for inflation of being 2%, they're talking about 2% on personal consumption expenditures. That's different from CPI. And if you go back and look historically, CPI always runs about 0.47, 0.48% hotter than PCE, personal consumption expenditures. This is what the Fed cares about. This runs a little bit hotter, and the reading we got this past week was 2.39%. If you factor out that 0.47% increase over PCE, we are already below the Fed's target rate for year-over-year inflation. So we're already there, which is very, very interesting. What is even holding it up over 2%? Well, that's where things get really fascinating. I'm going to shift your attention here to this chart. So this is what's been happening with year-over-year inflation as it pertains to the Consumer Price Index. And you can see we're now down at roughly 2.39%. And if you factor in that 0.47% disparity, this is really the Fed's target rate on CPI. It's around 2.47%, and we're at 2.39. We're there, right? We are at the Fed's target rate. Actually, and if you go back here and see what's been going on with shelter, one of the biggest components of CPI that's holding the value up is the shelter component. And the shelter component came in at over 4% annualized on this most recent CPI report. If you take a much more data-driven metric of shelter inflation, you'll see that shelter inflation is actually decreasing year over year, 0.5% negative year over year with the Apartment List National Rent Index. And if we right-sized the shelter component of CPI to the Apartment List National Rent Index, you'll see we would be almost at 0% inflation on CPI. It is that shelter component of CPI that is still holding us up in that mid 2% range. And if you right-size that, boy, we don't have any inflation at all. We are at a pretty much a static marketplace and really tilting towards a deflationary marketplace. So all of that should bode very, very well for bonds. But until this tariff noise has calmed down, until we see some trade agreements reached, or at least until the brinksmanship is over with, unfortunately, there's going to be upward pressure on interest rates because there's so much concern about investing in United States debt and the volatility of how much of that debt is owned by foreign entities. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam at highlandmtg.com. Have a good weekend.